Supply and demand, the driving force of the market. What makes the price of stocks or any other trading security go up and down? Debt, balance sheets, corporate profiles, company earnings, job reports, oil prices, bonds, commodities? Not really. The answer is simple: supply and demand. Anything else is the effect of supply and demand, the desire of buying or selling. Supply and demand is the foundation of market economy. Supply is the quantity of a stock or any other trading securities offered in the marketplace and represents the sellers. The sellers are often referred to as the bears. Demand is the quantity of a stock or any other trading securities requested in the market and represents the buyers. The buyers are often referred to as the bulls. Sellers and buyers are the yin and yang of the market. When the price of a stock or any other trading security drops to a certain level, $2 in our example, it becomes attractive to the buyers. More buying means more demand, which causes the price to soar up. As long as the supply can meet the demand, the price will keep going higher. When prices go up due to an increase in demand, more buyers, or a decrease of supply, not enough sellers, the market is in an uptrend. This type of market is called bullish market or bull market. During an uptrend, the bulls, the buyers, are in control. When a stock or any other trading security reaches a certain level, $11 in our example, it becomes less attractive to the buyers. There is now a reverse situation where those that bought those stocks at $2, $5, or $7, or even more, need to sell them. The buyers become sellers, meaning more supply, which causes the price to drop. As long as the supply exceeds the demand, the price will keep moving lower. When prices go down due to an increase of supply, more sellers, or a decrease of demand, less buyers, we are in a downtrend. This type of market is called bearish market or bear market. During a downtrend, the bears, the sellers, are in control. After some time of price moving up and down, the sellers and the buyers find some sort of equilibrium that maintains the price within a specific trading range. In the image below, we see the price fluctuating from $4.12 to $4.40 in a time frame of 6 months. This type of market is called sideways market. The price will remain within this trading range until something will disrupt the relative balance between supply and demand, causing the price to drop or soar depending on what buyers and sellers are doing. Generally, investors and traders shift from being sellers to being buyers and vice versa, depending on many factors: debt, balance sheets, corporate profiles, company earnings, job reports, oil prices, bonds, commodities, etc. Sellers and buyers, supply and demand, are the driving force of the market. Those other factors are simply the cause and effect of supply and demand. Both mindsets are needed when trading in the market. When investors feel optimistic about the company or the general state of the economy, they enter the market with bullish position. They buy or go long, which start driving the price up. When they feel pessimistic about the company or the general state of the economy, they enter the market with bearish positions, they sell or go short, which starts driving the price down. Investors and traders can make money on a bullish market as well as on a bearish market. Successful trading is being able to shift in and out of those mindsets depending on the general perception of the market. Support and resistance. The equation of demand and supply, the battle between bulls and bears, is what creates the market. When the bulls are in control, demand and consequentially price increases. When the bears are in control, supply and consequentially price decreases. What makes the price go up and down is the presence of large buying orders, more buyers than sellers. What makes the price go down is the presence of large selling orders, more sellers than buyers. When price moves sideways, there is equal strength between buyers and sellers. This sort of equilibrium between the bulls, the buyers, and the bears, the sellers, maintains the price within a specific trading range. When the bulls gain control over the bears, price will break out of the sideways trading range and will start moving up. On the other hand, when the bears gain control over the bulls, price will break out of the sideways trading range and will start moving down. When looking at charts, we are constantly looking at the interaction between bulls, the buyers, and bears, the sellers. When strong buying occurs around a specific price level, preventing the price from dropping even further, the price level is referred to as support. The support level is an area where buyers are expected to take control over price action. The logic behind support is that when the price drops down to a certain price level, it attracts interested buyers and discourages sellers from selling at a lower price. Support levels are generally located below current price levels. The line at the bottom represents support. When strong selling occurs around a specific price level, preventing the price from rising even further, that price level is referred to as resistance. The resistance level is an area where sellers are expected to take control over price action. The logic behind resistance is that when the price increases up to a certain level, sellers are more inclined to sell and cash in, and buyers are less interested in purchasing. Resistance levels are generally located above current price levels. The line at the top represents resistance. Usually, price trades near the support and resistance levels. Therefore, instead of thinking support and resistance levels, it is at times more appropriate to think support and resistance areas or zones. How to draw lines of support and resistance. Lateral lines of support and resistance can be drawn using any interval of time: 5-minute chart, 10-minute chart, hourly chart, daily, weekly, and monthly chart. The time frame to choose depends on whether you are a day trader, a swing trader, or an investor. Generally, daily charts and at times weekly and monthly charts are the most useful when looking at support and resistance. The first thing to do is to open up a chart using the daily time frame. When looking at the chart, go back and look at previous history: 6 months, 1 year, 2 years, 5 years. Then look at areas in the chart where the price has dropped, touched several areas, consolidated, and then either bounced back up or moved below it. Connect those areas by drawing an horizontal line across the chart. That lower line represents what we call support. Every time the price touched the support line and it bounced back up, the bulls were there to buy and push the price higher. Then look at areas in the chart where the price moved upwards, touched several times, consolidated, and then bounced back down or moved above it. Connect those upper areas of consolidation by drawing a horizontal line across the chart. That upper line represents what we call resistance. Every time the price touched the resistance line and it bounced back down, the bears were there to sell and push the price lower. Expand the chart to look at price action over the course of the past year or longer. Find other major areas of support and resistance. Come back to the 6-month or 3-month time frame and analyze the current price action in relation to those lines of support and resistance. Breaking support and resistance. Support and resistance is where demand and supply meet. As long as there is equilibrium between supply and demand, the price will remain in the trading range between the levels of support and resistance. When price finds support, buying pressure increases, causing the price to go up. When the price finds resistance, selling pressure increases, causing the price to go down. The price will remain within this trading range until something disrupts the relative balance between supply and demand, causing the price to drop or soar depending on what buyers and sellers are doing. Support and resistance also represent the psychological barriers that buyers and sellers base their investments on. When price reaches support and the buyers feel confident and positive about the state of the market or a specific trading security, they buy aggressively, causing the price to rise. When price reaches resistance and the sellers are concerned and have negative feelings about the state of the market or a specific trading security, they sell heavily, causing the price to drop. No matter how strong the barrier of support and resistance can be, those levels can also be broken. When looking at the chart, think about how it is like looking at the inside of a multi-story building. When the price goes up, it meets the ceiling. When the price moves down, it meets the floor. When the price drops and meets the support level or floor, the buying pressure should be there to hold and eventually push the price back up. If the floor is weak, price will break the support level. What was support now has become resistance. What was a floor is now a ceiling. The same is true when looking at the upside of the chart. When the price rises and meets the resistance level, the ceiling, the selling pressure should be there to hold and eventually move the price back down. If the ceiling is weak, price will break the resistance level. What was resistance now becomes support. What was a floor is now a ceiling. When the price rises up and meets the resistance level, ceiling, the selling pressure should be there to prevent further increase and eventually push the price back down. If the bears, the sellers, are not stepping in with strength and the bulls, the buyers, are willing to pay higher prices, the resistance level will eventually fail to stop the rising wave and the price will move up even further. When that happens, the resistance level now becomes support level and the price will keep moving further up until it reaches the next resistance level. The other side of the equation is that when the price drops down and meets the support level, also known as the floor, the buying pressure should be there to prevent further drops and eventually push and bring the price back up. If the bulls, the buyers, are not stepping in with strength and the sellers are willing to sell at lower prices, the support level will eventually fail to hold and the price will drop down even further. When that happens, the support level now becomes resistance level and the price will keep moving further down until it reaches the next support level. Draw as many lines of support and resistance as you need to, so that before entering a trade, you know exactly where the different levels of support and resistance, floor and ceilings, are. Buying at support. Now that we know how to find support and resistance and how to draw horizontal lines, what do we do with that information? Well, simply put, when price tests a support area and support is confirmed by the price remaining above it, we know that the buyers are there to push the price higher. Therefore, we want to enter a long position, which means buying. What if price reverses and tests support again? Watch the support area. If the price bounces off it and remains above it, and the stock is in an uptrend, it might be a good place to buy or to add to your original position if you're already long. What we don't want to see is the price moving and remaining below support. If it does, get out of the trade. You can always buy back if price moves back up above support. Always have your stop losses in place just a few pennies below support areas to protect your capital. Protective losses, or simply stop losses, give traders peace of mind in case price reverses and starts moving against their prediction. Stop losses are personally selected price levels that are designed to trigger a sell order to protect profits or limit losses. The stop loss is triggered only when the price reaches that level. If price keeps moving lower, you're out of the trade. Stop losses can be automatically set so that we don't have to be monitoring price activity all day long. What if price reverses and start moving higher, back above support? You can always get back in the trade. If you choose to re-enter the trade, set the stop loss once again. Selling a resistance. If we bought a support, when do we sell? When price tests a resistance area and resistance is confirmed by the price remaining below it, we know that the sellers are there to push the price lower. Therefore, resistance is the obvious place where we too should consider getting out of the trade and cash in. If we have a long position open, it is time to take profit. If we are short sellers, we can also initiate a short position. What if the price keeps soaring and breaks resistance? Watch the resistance area. Stay in the trade and see if the old resistance, now temporary support, holds the price above it. If it doesn't, get out of the trade. If price reverses and starts moving higher again, you can always re-enter the trade. Wait for a pullback intraday or a few days later to retest resistance, which has now become support again. If support holds, then buy back in.